annual letter, Warren Buffett defended stock buybacks and the viewpoint that they've had a bad press. He said that if you're told that all repurchases are harmful to shareholders, to the country, or beneficial to CEOs, you are listening to either an economic illiterate or a silver-tongued demagogue. In other words, he said that they are not always harmful. If a company is paying a reasonable price to buy back shares, rather than it's overpaying to buy back those shares, it's good for the shareholders too. Hi, this is your host Weronika. Today we'll talk about the 4 major insights for investors from the recently published annual letter to Berkshire Hathaway shareholders written by the 92-year-old legend Warren Buffett. Let's get started. One of the notable insights for investors that Warren Buffett shares is about compounding for decades. The earlier you start investing, the better. He says that over time it takes just a few winners to work wonders. He's been a successful investor for 80 years, and patience has a lot to do with it. And anyone who stuck with Berkshire from 1965 to 2022 saw their shares gain over 3.7 million% in value, while the S&P 500 still rose a solid 24.7%, including dividends over that period. Warren Buffett brings up specific investments of Berkshire Hathaway like Coca-Cola, which is the accurate example of how powerful compounding is. The purchase of Coca-Cola was completed in 1994, and the cash dividend they received from Coke that year was $75 million. While by 2022, the dividend had increased to $704 million. As he sums it up, growth occurred every year, just as certain as birthdays. And in order to benefit from compounding, it helps to start early and live into your 90s as well. Another insight is about share buybacks. Berkshire repurchased $7.9 billion of its own stock in 2022, indicating confidence it was undervalued. What's important to mention, as of this month, President Joe Biden urged a quadrupling of a 1% tax on corporate stock buybacks that became law in his Inflation Reduction Act last August. In the annual letter, Warren Buffett defended stock buybacks and the viewpoint that they've had a bad press. He said that if you're told that all repurchases are harmful to shareholders, to the country, or beneficial to CEOs, you are listening to either an economic illiterate or a silver-tongued demagogue. In other words, he said that they are not always harmful. If a company is paying a reasonable price to buy back shares, rather than it's overpaying to buy back those shares, it's good for the shareholders too. The biggest challenge to taking control of your personal finances, improving your investment returns, and building a better future is just getting started. This means getting organized, having a plan, and being disciplined. As Mark Twain once said, the secret to getting ahead is getting started. To break out the treadmill of slaving away each week only to have nothing left over, watching the savings you do have to get eroded away by inflation's vicious bite, or freeing yourself from the corporate grind requires that you master the conversion of time into value. To help you do this, we created a list of 4 simple steps to take control of your personal finances and life. You can download it for free by clicking the link in today's description. Warren Buffett brings up that during the decade ending in 2021, the United States Treasury received about $32 trillion in taxes, while it spent over $43 trillion. He proudly points out that Berkshire's contribution via the corporate income tax was $32 billion during the decade, almost exactly 0.1% of all money that the Treasury collected. He believes that Berkshire did pay their fair share in taxes, as he goes on saying that if there had been roughly 1,000 taxpayers in the US that matched Berkshire's payments, no other businesses nor any of the country's 131 million households would have needed to pay any taxes to the federal government. He makes a point that even though economists and politicians have opinions about the consequences of that huge imbalance, he, together with Charlie Munger, believe that near-term economic and market forecasts are worse than useless. He claims that their job is to manage operations and finances in a way that will preserve the company's staying power when financial panics or worldwide recessions come up. Regarding the future, he encouraged investors to follow what he's always been doing. Focus on the big picture rather than the short-term stock movements, high inflation, or the Fed. On top of that, he outlined that the future CEOs of Berkshire will have a significant part of their net worth in Berkshire shares, that will be bought with their own money. And last but not least, he encourages you to find a very smart high-grade partner, preferably slightly older than you, and then listen very carefully to what he says. That's it for today. Remember to subscribe to our daily newsletter. We study markets by clicking on the first link in the description below and subscribe to our channel. Thank you for watching.
And if you read Business Week, as I like to say, it would have appeared over that 45 years that we had done nothing but kick French bottoms because of Eurosclerosis, French incompetence, bureaucrats, etc., etc. They take too much time off, they have long holidays. But when they work, they're very productive and they get paid a ton more money than they used to, and we do not. Even the lowly Brits are up 60%. The Japanese are up over 100. How is it that our average hour worked in manufacturing has done so badly?